I wanted to talk about this new pricing model, the volume-based and then booking the revenue annually instead of on a multi-year basis. Both of those analysts love today. Why the change?
One of the biggest issues we've had with Splunk is you get so much value out of the platform, and it's a data volume-based product that people get scared on how much volume is going to go through. And we've heard for years that the lack of predictability is something they'd want to have a better option around. And so we came out with two pricing metrics a month and change ago that were one's an enhancement, one is new. The enhancement for data volume contracts is we've tiered the pricing and really condensed the tiers into much broader bands with an unlimited option at the upper end of that pricing curve. So now, if I start with 100 gigabytes of data per day and I start to see the value and I can see 100 terabytes, I know what my price is going to be and I don't have to be scared about the data volume. The alternative, which is probably more fundamentally appropriate long term, is just the amount of infrastructure that you need to operate the product. So we've got a virtual CPU and a virtual core option. We rolled both out because the way that you use the product could make one more advantageous for a customer versus the other. And customer success truly is our #1 corporate priority, and we want to make sure that customers have the optionality to choose the best option for them.
I want to come in to show you a chart that I'm showing inside my terminal for our Bloomberg audience. If you come in, GTV Go, basically showing for the week you're up 17%. You're having your best week now all year, going all the way back since last November. How much of the changes did you talk about today, introduce in the last month, are also helping boost that forward guidance? Because that was a big issue for analysts today.
Yeah, we're really excited about the results, the way that the results are being accepted, because you never really know on an earnings call how people are going to receive it. I think one of the bigger breakthroughs that we drove is we've been transitioning the company from a largely perpetual license model to a term and cloud model, and that can wreak havoc on the financial statements, and it's a big shift both for our customers and the investors. And this quarter, we released an annual recurring revenue metric, and we went back 5 quarters so people could see what did it look like in the distant or the recent past, and then where are we today, and being able to show people that we grew annual recurring revenue at 53% year over year and have a $1.44 billion ARR capability or metric within the company, I think really helped people to be able to cut through the GAAP-based revenue versus what do these annual contracts look like that term and cloud contracts are surrounding.
If there was a negative piece of information, free cash flow was about $30 million more negative than analysts wanted. Operating cash flow seems a little bit negative, but you're looking to make that positive in a few fiscal years. What are investors missing that you'd like to clarify about those numbers?
I think what they got this time, because we walked them through cash flow the past 2 quarters, is that really is a timing issue. That as you move from perpetual, where everything's paid up front, and we had perpetual licenses to keep it consistent, would ask the term license to be paid up front. As we shifted to term and cloud, we allow people to normally pay as they would with any term contract, which is annually, which obviously has a big impact on cash flow. And we declared it as a timing issue, but we weren't able to drive a model with enough clarity to give confidence in the forecast of the street. And this quarter we leaned forward, showing that we anticipate $1 billion of positive free cash flow in FY23, 2 fiscal years from now. And we'd always said it was going to snap back, and it will be back in the upper 20% range versus revenue, and I think that helped people understand that snapback.
You recently made $1 billion acquisition of Signal FX. Going forward, what could I look for in terms of organic growth versus acquisitions? What % will be both?
We have largely been organic growth, and even the Signal FX acquisition, which we're super excited about, the revenue from that company is not that large versus $1 billion acquisition price, but it enables us to get into this hot new category around observability, that as people move workloads to the cloud, it's really hard to look into the applications to see what's happening in the cloud. And the combination of a bunch of really cool organic products we've been pushing out, this data stream processing product that people are very excited about, with things like Signal FX and a smaller acquisition called Omnition, really provides the ability for our customers to get deep understanding metrics and health of applications on those cloud workloads. So I think that combination is going to result in some interesting revenue and some interesting customer success in the coming quarters.
Splunk's Doug Merritt on all things Splunk.